Welcome everyone to our Novograd & Company New Markets Tax Credit Conference. This is the New Market Tax Credit Basics, and I am your ringleader today of this three-ring circus. I am Brad Elphick. I'm a partner in the Atlanta office of Novograd & Company. All right, so what should I take away from this workshop? The answer is an understanding of how the New Market Tax Credit Program works. We want you, as I mentioned earlier, to walk away from here being able to use the lingo, know what it means, understand in your head when someone's talking about a deal, at what level they're talking about and how the deal flow works, and then ultimately see how you fit into the program. So let's talk about the New Market Tax Credit Program. The point of a tax credit is to incentivize investors to provide capital into areas that they wouldn't otherwise normally invest. Most of the time they're going to make investments in thriving communities. One of the reasons for this is that there's less perceived risk in a thriving community. And this is where the federal government comes in to incentivize investors to put money in low-income communities that are otherwise have inadequate access to capital. And so this is the incentive. This tax credit is a dollar-for-dollar reduction in their tax liability. So this makes investors happy, and who else is happy? Obviously low-income community businesses that benefit from this new infusion of investors' capital into low-income communities. Just to give you an idea of what the program is in a nutshell, we've come up with a definition. Community development entities must use substantially all of the proceeds from qualified equity investments to make qualified low-income community investments in qualified, active, low-income community businesses located in low-income communities. Easy enough, right? Y'all want to try to repeat it back with me? Here we have an entity who has an idea that, you know what, I've heard of this New Market Tax Credit Program. I should probably become a CDE, a Community Development Entity. Well, how do I go about doing that? Or the department within the federal government is the CDFI fund. They are responsible for administering and monitoring the New Market Tax Credit Program. So if you want to become a CDE, you have to submit an application, a CDE certification application, to the CDFI fund. The CDFI fund will review this application, and if you meet all the different requirements, they'll approve you as a CDE. So now you're a CDE, a Community Development Entity. What are your next options? You would then submit a New Market Tax Credit allocation application to the CDFI fund. Again, they administer the tax credit program. So in this application, we'll go through it in a little bit in some future slides here, you're essentially telling them what your business plan is if you receive an allocation of New Market Tax Credits and how you're going to use that subsidy to invest in low-income communities. And if they've reviewed yours and yours was a sufficient application, then you will receive a New Market Tax Credit allocation. And you have this authority, when you receive an award, you have the authority to go out and raise QEIs, Qualified Equity Investments. It's an important thing to know the difference is that when you receive an award, let's say you hear someone here today say, I got a $50 million award. That's not $50 million of tax credits. That's the authority to go out and raise $50 million of QEIs, Qualified Equity Investments. And those qualified equity investments will then trigger the 39% New Market Tax Credit. So now we know that we've got this capital in our CDE, and it's in the form of cash. We've now received some cash from an investor. Now we must go out and invest that cash into qualified low-income community investments, QLICs. And these QLICs must be invested into qualified, active, low-income community businesses. But let's say you go out and find a project that qualifies, and it must be located in a low-income community, and so then you would make in a qualified low-income community investment or QLIC in the form of debt or equity into this qualified business. And you must use substantially all of those proceeds that you receive from your investor to make investments into the low-income community. They don't want you to take funds from an investor and then peel off a substantial portion of them and fees and keep it in your pocket. They want those funds that the investor has made into the CDE to make it actually down into these qualified projects. So here we have, again, the CDE must use substantially all of the QEI proceeds to make QLICs, qualified low-income community investments, into a qualified active low-income community business. located in a low-income community. So all that I just went through right there is a visual representation of the definition that we talked about. So if you can understand this simple process here, then you have a very good understanding of how the new market tax credit program works.